If you have a mortgage, chances are your interest rate is only heading in one direction, up. And while the Reserve Bank left rates on hold yesterday, rising inflation has economists tipping an increase as early as August. With household debt at record highs, that's bad news for borrowers. Martin North is the director at Digital Finance Analytics, and he joins us now. Welcome.
Hello.
The RBA wasn't expected to lift rates yesterday, but many economists now think they'll go up from the middle of this year. What do you think, and how quickly could they go up?
I don't think they're going to go up as fast as the markets are expecting. I think the Reserve Bank will stick to its religion of low rates for as long as possible, but they are going up. And of course, banks are also putting rates up out of cycle of what the Reserve Bank is doing because of the international costs of money and the fact that the very cheap money from the Reserve Bank has also stopped. So expect rates to go higher.
You've compared the period we're in now as being like 2007, where interest rates went up ahead of the GFC, but on steroids. Why do you say that?
Well, there's a couple of factors. One is the average mortgage is a lot bigger. So if you've taken a mortgage out over the last year for the first time, your mortgage will be about 15% bigger than it was, which means, of course, you're more sensitized to what may happen. Also, because rates have been so low, even small moves in percentage terms has a very big impact in terms of the cash flows that you will be impacted if they go up. The third is that incomes have been very static for a long, long time. And whilst there's a lot of talk about maybe interest rates going up and wages going up, the fact is at the moment wages are not going up as fast as interest rate expectations. So people are being caught with essentially large mortgages and incomes under pressure at a time when costs of living are going through the roof.
What proportion of new home buyers would find themselves in mortgage stress if interest rates did go up?
Well, at the moment, in my surveys, I use a cash flow measure of money in, money out. About 75% of first-time buyers who bought in the last year are already on the edge. In other words, they can just about make those mortgage repayments, but they've got very little wriggle room. Overall, if you look at all households, it's about 41%. So the recent first-time buyers are very much in the eye of the storm, but they're not the only people who potentially are being impacted by this.
Some of the banks you've been talking to are already quietly advising some of their customers to sell before rates go up and prices fall. What sort of buyers are being told to sell now?
Yes, it's very interesting because, the banks want to obviously keep you in your house if you can possibly afford to. But they recognise that sometimes personal finances change and therefore the best story is to sell while you can. Three groups. The first is recently purchased first-time buyers. Some of those are already in difficulty, but it takes perhaps 2 or 3 years for that to work through. The second group are those who are moving into retirement, but still with large mortgages, and suddenly they're out of the workforce, perhaps unexpectedly, and the money they were expecting to get from bank deposits has gone away, and so they are finding it very difficult to meet those commitments. The third group is property investors, particularly in the high-rise apartment sector. There are many people there who've got vacant properties whose costs are accelerating and frankly are going backwards in terms of their investments. So the investment sector is also being hit.
There's been a rush of people moving out of CBDs to regional Australia and driving up house prices there. Of course, some of this is obviously pandemic related. Will those values hold up, and what would a major decline mean in those regional communities?
Yes, well, I think some regional areas are going to feel a big draft because I'm already seeing in my surveys some people now saying, well, maybe it's time to move back closer to the city, not least because, in fact, values in the regions have gone up a lot higher, so they're sitting on some capital, but also, from a convenience perspective. I'll make the other point, though. A lot of regional locals are now being pushed out of the areas where they currently live and are having to buy in other areas further away from the regional centres. And a lot of those are finding it very difficult too. So it will definitely change the regional footprint, but I'm not sure that the flow back is going to be massive. I think it's going to take a lot longer once the COVID situation settles down. But I do think the rising interest rate story could play into that.
Martin, thank you for your analysis this morning.
Good to talk to you.
Martin North is the Director of Digital Finance Analytics, joining us here on RM Breakfast, where the time is 20 minutes to 7.